we talk to institutions about there being two big markets right now. There's Bitcoin, which is money. I think it'll get to $1 million in the next 10 years. And then there's stable coins and tokenization, which are these freight trains bringing trillions of dollars of capital onto markets. I agree with what you said. I think in 5 to 10 years, essentially all payments will be stable coins and all assets will be tokenized. And you're hearing the largest voices in Wall Street saying the same things, right? So I think those are fait accompli. And then we talk to institutions about how to allocate to this space, which is a mix of assets like Ethereum, Solana, associated assets like Chainlink and DeFi apps, and then companies that are building in the space like Circle and Coinbase and Kraken, and both in public and private markets. That's sort of the stablecoin portfolio. As far as ETH, I think there's only one question really left on ETH, which is,
what if I told you that Bitcoin still might be in its earliest chapter, not its final act, even after all the headlines, all the cycles, and all the massive gains we've already seen? Not hype, not speculation, not internet excitement, but a serious research-backed perspective from one of the most respected voices in crypto today, Matt Hougan. And once you understand the framework he lays out, you start to realize the real story of Bitcoin might be far bigger than most people are willing to believe. Most people look at Bitcoin the wrong way. They focus on price swings, short-term news, or they assume the big move has already happened. But Matt Hougan argues that this misses the structural forces actually driving Bitcoin's long-term value, things like global adoption, institutional flows, and the slow but steady integration of digital assets into traditional finance. From this perspective, Bitcoin isn't just a speculative asset, it's becoming something much deeper in the global financial system. Now let's hear what he's about to say.
Look, I think the institutional money is going to come in for the next 10 years. Institutions still on average have 0% allocation to crypto. That's the wrong allocation. I think they'll get to 5. This week alone, I'm meeting with Morgan Stanley, Wells Fargo, and Merrill Lynch. That's Monday, Tuesday, and Wednesday. And that money is going to flow into the market. It will mean that the bull market is steadier, lower volatility, and longer lasting. That's my guess. I do think retail money will come back into crypto as you see prices accelerate. I don't think it's gone to AI forever. I also think it's okay to like AI and like crypto at the same time. I do. And I think we can hold both of those thoughts in our mind. These are the largest markets finance has ever gone after. It's intelligence and money. We've never sort of tackled those sorts of TAMs. I think it's fine to have both. But I think retail money will come back into the market as prices increase. It always does. I absolutely do. I don't know if we'll get back up to new all-time highs this year, but I think the year end will be much, much better. There are just some really positive long-term forces in crypto right now. Stable coins are a juggernaut. Tokenization is a juggernaut. Concern about debasement is a juggernaut. Improving tokenomics is also something that's happening. Improving sort of centralization on the L1 and things like ETH is also something that's happening. You're seeing blockchains execute better on their technical roadmap than I've seen in my 8 years in crypto. These are pretty big trends, and you put them all together, it's to my mind a very positive environment. Could there be scenarios where it doesn't occur? Of course. Clarity fails, or the world goes into a massive recession that's hugely risk off, or there's some other unforeseen issue. But absent those, I think we're materially higher by next year, by the end of the year. And then I think 27 is a pretty great year for crypto. I think there's a very conservative case for Bitcoin to get north of $1 million a coin. And here's the case. If you think of Bitcoin as digital gold, there are only two factors that matter. It's how big is the store of value market and what Bitcoin's share is, right? Right now, the store of value market is $40 trillion and Bitcoin's share is about 4%, which is how do you get to $75,000? Just simple math. The mistake people make when they evaluate Bitcoin is they say, well, maybe Bitcoin will get to 25% of the market, right? I could imagine it being a quarter the size of gold. And they're like, okay, then that could be a $10 trillion market and maybe it's a 5x from here. But that math is wrong because the gold market, the store of value market, has been growing dramatically for the last 20 years. When the gold ETF launched in 2004, the entire store of value market was $2.5 trillion. It's had a 12.5% CAGR for 20 years. If you continue that for 10 years, right, to 2035, Bitcoin only has to take 15% of the market to be worth $1 million a coin. If it takes 30% of the market, it's 2 million. If it takes, you can go on from there. You can get to these really dramatic numbers with really conservative assumptions. All you're saying is that the store of value market needs to keep growing the way it's been growing as governments print more debt, not grow faster, grow the way it's been growing. And Bitcoin has to go from about 5 to 15% of the market in 10 years. That seems like almost a slam dunk, right? Almost a slam dunk. It's a very conservative assumption. Now, that's not 10x in a year. If you want 10x in a year, I think those opportunities exist. I think some of the DeFi apps, as tokenomics improve, have 10x style in a year appreciation potential. Mm-hmm. But on the majors like Bitcoin, you're still talking about an asset that could 20x from here with relatively conservative assumptions in 10 years. Good luck finding that in stocks or bonds. Yeah, look, Bitcoin is an emerging store of value, so you can't expect it to perform exactly the same as gold over any short period of time. Gold had an idiosyncratic driver, which is central bank buying. Central banks aren't buying Bitcoin. That's what lifted the price of gold. It wasn't retail buying. It wasn't financial advisors buying. It was central bank buying after the US seized Russia's treasury assets. That inflected the price of gold. Bitcoin had its own idiosyncratic moment, which is this 4-year cycle. It's a classic crypto winner. And so you had idiosyncratic drivers that caused the price to separate. But go back to COVID, right? COVID to today is the great inflation of our lifetime, right? The dollar lost 25% of its value. Bitcoin is up 15x since the start of COVID. That's a pretty good store of value, right? Gold doesn't always go up. So Bitcoin is not going to just do gold's return times 5. There's no world in which that works. You have to pan out a little. It's emerging. It's doing great. Since the start of the Iran war, Bitcoin's up, 14%? Gold is down 5. Is gold broken? I think we need to pan out a little bit.
Yeah, so zooming out.
Yeah, we sort of, we talk to institutions about there being 2 big markets right now. There's Bitcoin, which is money. I think it'll get to $1 million in the next 10 years. And then there's stable coins and tokenization, which are these freight trains bringing trillions of dollars of capital onto markets. I agree with what you said. I think in 5 to 10 years, essentially all payments will be stable coins and all assets will be tokenized. And you're hearing the largest voices in Wall Street saying the same things, right? So I think those are fait accompli. And then we talk to institutions about how to allocate to this space, which is a mix of assets like Ethereum, Solana, associated assets like Chainlink and DeFi apps, and then companies that are building in the space like Circle and Coinbase and Kraken, and both in public and private markets. That's sort of the stablecoin portfolio. As far as ETH, I think there's only one question really left on ETH, which is L1 block space a commodity? Because if it's a pure commodity and investors are ultimately don't care if it's Ethereum, Solana, or any other L1 or L2, and things move seamlessly between them and it's purely commoditized, it's going to be very hard for Ethereum to capture enough value to justify its current market cap. If block space is not purely commoditized, if you can charge differentially for different block space, if there's brand value, if there's brand moats, if cross-chain is not actually as easy as people imagine it might be, then I think it's dramatically undervalued, because the scale of transaction activity on stablecoins and tokenization based on its current market share, and it's still winning many of those mandates, is massive. I think it's like underestimated by people by a factor of 10,000, particularly with AI agents coming into the space. The number of transactions is potentially massive. And so I think that's really the question people are asking around ETH. Ultimately, is L1 block space a pure commodity, or is there differentiated pricing and value capture? And I think it's a really interesting question for for what it's worth.
Another important insight is that Bitcoin doesn't behave like traditional assets, and that's actually a strength. Unlike stocks, bonds, or commodities, Bitcoin often moves on its own path, with a low correlation to other markets. This is one of the main reasons institutions are interested in it. It can help balance a portfolio because it doesn't always react the same way as everything else. Of course, in the short term, big global events can still push all markets in the same direction. But over time, Bitcoin tends to separate and follow its own long-term trend based on adoption and network growth. Now, there are real risks to consider. Things like government regulation, global economic downturns, and future technological threats such as quantum computing. These are valid concerns. But the key point is that none of them break Bitcoin's long-term story. They might slow down adoption or create temporary pressure, but they don't stop the overall direction. In fact, the crypto industry is already actively working on solutions to many of these challenges.
Look, I never think there's a monocausal explanation for these sorts of moves. I think to an extent, capital fleeing the Middle East is a big piece of it. To the extent crypto sentiment hit all-time lows, right? Remember, it was 4 on the crypto fear and greed. That's a pretty asymmetric reading where there's only normalization. We've seen that normalization happen. I think I have this personal thesis: the crypto winter started in the early parts of 2025, not in October. And so we're actually deep into that winter. And I think there's a natural cyclical bottoming process. And I think the world is so crazy that crypto looks sane, which I think is helpful for crypto as well.
Look, like
you have these mega trends. Yeah.
It's like an
and
off-ramp.
I think that process helps. Just one note on my thesis that we entered the winter in January. You can kind of look at in 25. If you look at crypto, there were really 2 markets. There were Bitcoin and ETH, which did relatively well because there was a huge amount of ETF inflows. And then there was everything else, which just went straight down, right, from January. Alt layer 1s were down like 70% in 2025. And if you look underneath Bitcoin and ETH, outside of those institutional flows, there were selling from long-term wallets, that were selling from whales consistently throughout the year. And so I think you had sort of 2 markets. You had institutional crypto that like kept going in 2025, but crypto retail really started to punk in early 2025. So I really do think we're pretty deep into the crypto retail winter. We may be in the spring. So I think that cyclical element is pretty important and maybe was papered over by the ETF flows.
Yeah.
So there are 2 levels of concerns I have there. One is that it's a challenging problem that I think the Bitcoin community will solve, even though there's some edge cases around what to do with wallets that will be complex and difficult and painful. But the fact that we're talking about it and dedicating resources to it means I suspect that we'll solve it, right? So there is a risk, but I think we'll solve it. But I do think it's dramatically dragged down returns. And the reason for that is that when I go and I speak with sort of investment committees, which are like 8 guys at an advisor that manages $50 billion, they're all between 40 and 60. And I have to convince all of them to allocate to Bitcoin. What happens and what's happened for the last year is at the end of the meeting, someone raises their hand and says, what about quantum? And I can explain what's going to happen broadly with quantum, but that process takes 6 to 9 months. And it really has slowed down institutional adoption. So long term, I think we'll solve it. It's challenging, we'll solve it. But it is slowing things down, and it has contributed to the negative price performance. You can even see that in the relative performance of Bitcoin and Bitcoin Cash over the last year, which are very different charts. So I really do think quantum has had an effect, but I think we'll get past it. Actually, outside of Bitcoin, I think AI's benefit to stablecoins tokenization and the plays in that space are absolutely enormous. I also think that if you believe in the AI-driven deflation theory, which is that it'll spark a massive deflation, governments will meet that with huge amounts of money printing. That's what we did on China entering the WTO, which was the last major deflation. We just swamped that with new liquidity. That's positive for Bitcoin as well. So I agree that it's a long-term positive catalyst. On the recent relative performance versus software stocks, I actually am somewhat inclined to believe that that's a statistical anomaly, but I don't know for sure, right? It's entirely possible that there were 2 idiosyncratic events, which were the Fourier cycle and the October 10th deleveraging, and then a freak out about software stocks. and that the recent correlation is just like a short-term anomaly. But I could be wrong about that. Long term, I think it's a positive catalyst. Short term, it's something to think about, but I haven't found a reason for those two to be linked as closely as they have been in those charts that everyone circulates. The lack of correlation is one of the primary reasons that institutions allocate to crypto. If you
Yeah.
look at like BlackRock's marketing material, the first thing they talk about is the low correlated nature. And even when it was sort of trading somewhat like stocks on a long-term basis, if you look at 90 or 180-day correlations,
Hmm.
they were still relatively low. So it's definitely the case that as we see this divergence, that's beneficial. Long-term, though, you have to assume it's going to be relatively lowly correlated, because what fundamentally drives Bitcoin and crypto is just different than what fundamentally drives most other assets. There are times when macro trends can overwhelm things and all correlations lift to one. But I think this paradigm where they have different returns is actually the normal paradigm across long periods of time. And it's definitely helpful when we go and speak with institutions.
According to Matt Hougan, a variety of factors always contribute to changes in the cryptocurrency market. He notes that the market's level of dread has dropped to incredibly low levels, and when that occurs, prices usually rise as sentiment returns to normal. Additionally, he thinks that particularly for regular investors, the cryptocurrency winter actually began earlier in 2025. The market was divided into two very distinct realities, with Bitcoin and Ethereum holding up better due to significant institutional inflows like ETFs, while the majority of other cryptocurrencies were already sharply declining. He also discusses various difficulties, such as worries regarding quantum computing. Large institutions may be discouraged from investing even if these issues are expected to be resolved, because it takes time to fully comprehend and feel at ease. He also draws attention to promising long-term factors that could help cryptocurrency as a whole, including as the development of artificial intelligence and the potential for governments to generate more money in reaction to economic shifts. Lastly, his primary recommendation is to make wiser investments. He advises concentrating on avoiding the weak projects that exhibit little development or acceptance rather than attempting to predict which one will succeed. His primary point is that, in spite of immediate difficulties, cryptocurrency has a bright future.